Hello and welcome. So this lecture video starts on page 100. So I just wanted to return back to this example and make sure I just reiterate some of the more important points about these journal entries here. And then that concludes our discussion about sales returns, allowance, and sales discounts. And so then I'll do some practice problems associated with that. Okay. So again, returning back to our sales return example, recall Z-Mart sale for $2,400 at a cost of $1,600. The customer returns part of the merchandise. The returned items sell for $800 and the cost basis was $600. So when we have this situation, we have to first recognize the sales return and allowance. So remember, this is a contra revenue account. So we debit sales returns and allowance for $800, and then we credit the accounts receivable, which basically means we're taking $800 off their bill because they're returning the merchandise. Okay, so accounts receivable goes down by $800. Then we have to recognize that they've given us the merchandise back. So our merchandise inventory goes up. So we debit merchandise inventory for $600, and then we credit the cost of goods sold. So basically, this is almost a reversal of the sale of the journal entry that we did for the sale, except that rather than debiting sales, which would be the exact reversal, rather than debiting sales, we keep track of sales returns and allowances separately, and we show that separately on the income statement so that anybody reading the income statement can see, here's how much sales returns and allowances they've had and how much sales discounts that they've had. Because as an investor or any other interested party reading these financial statements, that's what you want to see. Because if you notice that a company has a lot of sales returns and allowances, that could be a problem. That means that maybe what they're selling isn't very good, and that could spell problems for future sales. Okay? So that's why we want to show it separately to in the interest of full disclosure and transparency. When we have a sales allowances, we don't do this journal entry, right? We just do this journal entry, similar to that one. We don't do this one. Why don't we do this one? Because the customer is going to keep the products that we sold them. They just say, maybe they're not quite the right color. It's got a scratch. They're somewhat defective and we want some money back. So in that case, we're going to just debit our sales returns and allowances and credit the accounts receivable. And by crediting the accounts receivable, we're basically giving them that price reduction. Okay, money off their bill. That's what that is. Okay, so let's go on and look at the next page right over here. Sales discounts and returns. As I was saying earlier, those are all contra revenue accounts. They show up on the income statement. And our net sales is equal to our sales less our sales discounts and sales returns and allowances. Remember what I was saying earlier is we show our sales less our sales returns and allowances gives us our net sales. Net sales minus cost of goods sold gives us our gross profit. Gross profit less our other operating expenses and other expenses, as we'll see in future chapters, gives us net income. Okay? So let's look at some practice problems. These two, and actually what I want you to do is pause the lecture video and do number 102 on page 102 and then do number 103 on page 103. Okay? All right, so let's go ahead and pause the lecture video and take a look at those. Okay, so try those and then check your work. Thanks. Hello and welcome back. So let's see how you did. So number 102, on October 1st, Robinson Company sold merchandise in the amount of $5,800 to Rosser with credit terms 2, 10, and 30. That means 2% within 10 days. That's the purchase discount. You pay within 10 days. Otherwise, the full amount is due within 30 days. The cost of the item sold is $4,000, and Robinson uses a perpetual inventory accounting system. The journal entry that Robinson will make on October 1st is D. Okay, so we made a sale. So this one, A is not right. Well, it's a debit to sales. We made a sale. So as a debit to sales, that doesn't make any sense. Debit to sales. No, not debit to sales. That means sales are going down. C, the actual journal entry to recognize the sale is right, but it doesn't include the cost of goods sold. And then E is similar to C, except it's for the cost basis, and it also omits the cost of goods sold. So remember, when we make a sale, we have to do 2 journal entries, one to recognize the sale, one to recognize the cost of goods sold. That's why D is right. And if you chose E when it's even not an option, think about that, okay? I'm sure you didn't do that, all right? All right, so anyways, let's look at 103. On October 1st, Whaley Company sold merchandise in the amount of $5,800 to Lee Company with credit terms of 210 net 30. The cost of the item sold is $4,000, and they use a perpetual inventory accounting system. Whenever it says that, that just basically means that they're debiting cost of goods sold and crediting merchandise inventory each time they make a sale. They're updating their cost of goods sold and merchandise inventory records each time they make a sale. That's what that means, okay? So Lee pays the invoice on October 8th and takes the appropriate discount. What is the right answer? The right answer is E. Okay, so why is A wrong? Well, that doesn't include a sales discount. Why is B wrong? Well, that doesn't include the discount. It's also for the wrong amount. C is wrong because it's for the cost basis. Okay, it's for the cost basis, not what you sold it for. And then D is wrong because it doesn't include a sales discount. E is the right answer. So remember, we get 98%, because it's a 2% discount, we get 98% of the outstanding accounts receivable. That's how much cash we get. And then we debit sales discounts for the 2%. Remember, sales discounts is a contra revenue account that shows up on the income statement. Okay. And then we credit accounts receivable for the $5,800, which is what we initially sold them, right? That was the initial debit to the accounts receivable when we made the sale. Remember, we debited accounts receivable, credited sales when we made the sale. And so the outstanding balance in accounts receivable is $5,800. So to zero out the accounts receivable and show that they've paid the full amount, we have to credit accounts receivable for $5,800. We only get 98% of that of their outstanding bill back, though, because we gave them a 2% sales discount. So that 2% goes to our contra revenue account of sales discounts right there. Okay, and again, this shows up on the income statement. All right, so I'm going to end this lecture video now, and then the next lecture video we'll pick up where we left off and talk about completing the accounting cycle. Thanks so much.